I would like to read to you a blog from the Office of Financial Research, who does great work in identifying data gaps in the industry and publishing many, many working papers on them. They like to cover the repo. They provide the actual repo data, among some other very important data sets like hedge funds and treasury market price impacts. You have fails to deliver, fails to receive, all that good stuff. But I've been arguing with a bunch of complacent fools for the last 2 years about this repo. Here's another shred of evidence for you, despite never receiving any on your end, about why the repo does contain risky assets that were purchased in 2020's SLR monetary policy regime. For years, regulators have called for greater insight and transparency into the U.S. repurchase agreement market. As a crucial source of funding and liquidity for the U.S. financial system, repos provide short-term financing to banks, securities dealers, and other financial institutions to fund their liquidity provisions and leveraged investments. Currently, the daily volume of transactions in all U.S. repo markets exceeds $4 trillion. Now, this is published on August 24th. Now, the 2.2 that you're seeing from the Fed side is not the whole repo market. There's several prongs of the repo market. Now, within the U.S. repo market, the non-centrally cleared bilateral segment, the one that's non-Fed, where repo transactions are conducted between two firms without the involvement of a central counterparty or custodian, like BlackRock, Vanguard, or the Fed, for example, has been a blind spot for regulators. Gary, unlike other repo segments where information and data are regularly published, the wholly bilateral nature of these transactions means there is no central source of data on this segment of the repo market. What is known about the non-centrally cleared bilateral market? Until recently, little was known about non-centrally cleared bilateral repos. In January 2022, the Federal Reserve Bank of New York updated their primary dealer statistics to capture the segments of the repo used by primary dealers. Figure 1 shows the total split of primary dealer reverse repo between different repo venues, where we estimated primary dealer non-centrally cleared bilateral reverse repo prior to 2022 by calculating it as a residual, thereby extending the sample before the change of primary dealer statistics. On average, during the first 3 quarters of 2022, the non-centrally cleared bilateral market made up $1.19 trillion of primary dealer reverse repo, 60% of the total, and $0.94 trillion of primary dealer repo, 30% of the total, was for the primary dealer repo. So 37% of the total of the primary dealer repo, and then 60% of the primary dealer reverse repo. Now keep in mind, if I do a repo with somebody and it's a non-centrally cleared bilateral repo, if I do a repo, the other person that I'm transacting with is doing a reverse repo every single time. That's how it operates. Now, at more than $2 trillion in total exposure, this would make non-centrally cleared bilateral repo the largest segment of the repo market in gross exposure by primary dealers. Moreover, our estimated series prior to 2022 shows the primary dealer volumes in non-centrally cleared bilateral reverse repo have been stable during the previous 3 years, averaging $1.1 trillion, or 60% of the total, in 2021, and $1.2 trillion, or 62% of the total, in 2020. This is figure 1 that they referred to above. Now, non-centrally cleared bilateral repo likely contains a greater share of riskier collateral that they bought in 2020 during SLR than other segments of the repo market. One feature of the market that attracts primary dealers is the ability to lend against non-Fedwire eligible specific collateral. Now, this is where what I've been trying to say forever comes into play. They're using non-treasury securities as non-cash collateral by using non-centrally cleared bilateral repos with joint accounts with people that do have centrally cleared repo transactions. In figure 2, the estimates show that non-centrally cleared bilateral is the primary venue for the use of asset-backed securities, agency excluding MBS, and agency commercial mortgage-backed securities collateral in reverse repo for primary dealers. Now this is where it gets interesting. Figure 2, non-centrally cleared bilateral share of total primary dealer repo by collateral, %. You have your repo, which is the opposite of a reverse repo, and you have treasuries, primary. That's normal. Then you have reverse repo. Look at the other The other is almost, and it's more than Treasuries excluding tips, and it's also more than Treasury tips. So, how the F do you explain this with your standard repo model that's been around since 2013? You don't. You read the policy changes and you look and you realize, holy shit, they leveraged everything to the tits in 2020. They bought up everything in 2020, and now in 2022, they're separating it all out. They're going unencumbered versus encumbered. Two more terms that were defined in the NSFR net stable funding ratio filing that came out over July 4th of 2021. But no one reads this shit. No one. Because they're too busy circle jerking on social media. It's never going to work. I'll link this below. But yeah, this is a large part of why the markets have to crash up. Not down. At least not yet. I mean, Burry was early in The Big Short. He's early here too. He's not wrong. He's just early again. So this is one of the most unlooked at areas of finance, and it's the most least understood because everyone would rather chase MOAS. And by the way, last time I looked, DRS still hasn't done shit. So what's the excuse now? Have a good one.